Thank you. Thank you very much to AIM Summit. Thank you, Rachel. And thank you for joining us this afternoon. I think we spent this morning listening to some rather wonderful economists telling us about what might happen or what might not happen in the future. But this panel is going to really focus and drill down to how the things that are happening in the wider world could be affecting private credit strategies in the private credit market. So to that end, I'm going to ask each of our panelists, starting at the end with Symon, to introduce themselves, and then we'll kick off with trying to find out what our panelists think might be happening for this sector. So, Symon.
Thank you. I'm Symon Drake-Brockman, the managing partner of Pemberton. We manage about 20 billion of capital across direct lending, NAV financing, risk sharing, and working capital finance.
Hello, everyone. I'm Nicole Downer. I'm managing partner at MV Credit. MV Credit has been an active participant in the European direct lending markets since 2000. And we focus on the upper mid-market within Europe.
Matthias, founding partner of Avellinia Capital. We're a London-based fund focusing on asset-based lending, so we finance asset portfolios.
James Ruane, managing director at CDPQ, which is a Canadian pension fund with over 400 billion under management. Our capital solution group focuses on asset-backed lending.
So thank you, everyone. So Nicole, I'm going to start with you. It's an interesting economic climate out there. There's always something that's going to be a challenge, depending in what part of the capital structure you're investing. But tell me, what is currently challenging your business?
As you said, difficult environment, a lot happening. The only thing we know for sure is there's a lot of uncertainty. It's difficult to know what will happen next. So by and large, I would say the challenge for, I would imagine, a lot of us is a lot of people have pressed a pause button to figure out what is going to happen next and do nothing till they know what's going to happen next. So that presents challenges in different ways. In terms of the origination side of things, M&A is generally down and kind of deal volume is down. So what that means is that the opportunities we're seeing as direct lenders tend to be more specific to the portfolios that we're already lending to, and that can be in the form of add-ons, recapitalizations, things like that, but certainly lower deal volume than we were seeing, for instance, a year ago. But to balance that, I would say, certainly in our market, the kind of competition in the past has been through the banking system, which has very much retrenched. And we've seen that retrenchment go even further in the last 12 months. So while we're seeing supply, demand going down, we are seeing supply going down even more. So I think there is quite a strong opportunity for direct lenders like us who are still active because that side of the supply chain is gone and capital is definitely scarce. So we're seeing better deals, lower leverage, better pricing, better terms on documentation, but fewer to choose from, and one of the keys of the success of credit is being selective and choosing the right credit, so we have to make sure we navigate that. I guess the other side of the business, we lend money, but then we raise money to lend it, and the capital raising side is definitely more of a challenge. It's taking longer. Capital is definitely scarce at the investor level, so we are seeing investors taking their time, writing smaller checks than they used to, being a lot more picky, which kind of works for the managers that have longer track records, but newer managers, I think, certainly are finding that more challenging as well.
Thanks, Nicole. Symon, is any of that resonating with you?
I think I'm on here. I think you're going through quite a significant economic readjustment because of interest rates and inflation. That usually takes a 2-year period. That's effectively what happened back in 94 and 05 when the Fed tightened over 300 basis points. We had the Asia crisis in early 97, which was a kind of repercussion of that rate tightening cycle. and you're just starting to see some of the consequences of the rate movement coming through at the moment. That equilibrium won't come back into the market until next year, and you've got to get to a point where a certain amount of confidence is restored in the markets. You're seeing it slowly come back in public markets, but I think if you look at alternatives, the focus on quality of businesses, focus on cash flow, and I'd say actually what's really, really important at the moment is focus on quality of management teams that are managing the investments. And that's been, I think, a huge adjustment for a lot of management teams that lived in a low interest rate cycle with expanding multiples, which took a lot of pressure off performance and focused on just kind of following the wave, so to speak.
Matthias.
I think what I would like to add, and I agree with very much everything that was said by Nicole and Symon. I think the additional challenge we face at the moment is that when we look at the crisis that happened over the past 15, 20 years, it was in the end it was always the central banks that came to the rescue. And why could they do that? Because there was no inflation. And that's very much a different situation right now. And so I think the big unknown for everyone really is now all of a sudden you have to fight on two fronts. You have inflation, yes, it's coming down, but it's by no means back to the levels where central banks would like to have it. At the same time, you're facing uncertainties that are also part of the result of years and decades of too much money, is that you've got over leverage, you've got leverage in pockets where you might not expect it. You're getting thrown curveballs by the market or by financial institutions, like we've seen with SVB. I mean, just the fact that a bank basically is going under because in the end, it had too many deposits, too high deposits, that it then had to invest somewhere, and it did that in a not so smart way. But that's just showing that there's so much liquidity that has built up over the years, and where these readjustments to those to that over leverage come from is not particularly clear at the moment. So while in the past there was always the white knight of the central banks, and during the pandemic, of course, also governments with government aid coming to the rescue in an inflationary environment, that's not possible anymore. So that's an additional complication of the situation at the moment.
Thanks, Matthias. Have you got anything to add to that, James?
I think really just one thing, which is to build on what Matthias said, which is we've had these factors like high inflation and central bank tightening, which has been out there for maybe 6 to 8 months. I think what you've seen post-SVB and Credit Suisse is probably that moving into a slightly new phase, which is the banking sector itself is starting to tighten credit. You see that when you look at credit surveys. You saw this morning banks in the UK perhaps planning to tighten mortgage lending. And I think that's going to actually then have a real impact on the real economy. So moving maybe from just a financial and kind of money market level of pressure into the real economy in the coming months.
Would you agree with that? Yeah. Okay. So you sort of identified some of the challenges that your businesses are facing, whether it's asset raising, different valuations. But Matthias, what are you doing to manage your business and your portfolio to sort of counter some of these challenges? What have you been forced to do, and what have you also decided, let's put some protection in here, we'll have to change some things?
Yeah, I mean, I think the mindset has shifted from financing growth to, making or financing maybe working capital or extending runway or basically maintaining at least a status quo. So in what we're financing, the focus has very much shifted from, for example, on the e-commerce side, one of the biggest things was advertising and inventory spend financing that, because they were just growing so quickly. Right now, it's more to funding rounds with venture capital firms have dried up, so companies are looking at extending their runway if they're not yet cash flow positive. They're looking at working capital solutions, at factoring, invoice financing, these type of things. So I think within whatever you're doing, there's a shift of focus to a more conservative cash preservation side of things, and so that's been a consequence for our portfolio composition, for what we're doing. Also, you decide do you want to play more in the consumer end borrower space? Do you want to look more at SMEs? Do you want to look more at growth opportunities? Do you want to look at stable opportunities, maybe at a lower yield, etc.? So it's those questions that we're looking at the moment.
Symon, have you had to make any adjustments to your portfolio or the way you're doing things?
I don't think we've changed how we look at analysing companies that we lend to in the process. What we've done, what I think is really a key part of this piece in the cycle, is the quality of monitoring and the follow up with what the business plans are, what management's doing to manage the situation. I was talking to one of the leading private equity firms the other day, and we were discussing that credit is actually, I think, in reasonably good shape because a lot of management teams kind of got match fit through COVID. They had to deal with an incredible shock coming into their business. They had to adjust inventories, cash flows, etc. And so, although for all of us, going from a zero rate environment to where we are today has been a shock for most people, the quality management teams, and actually most management teams, have done a pretty good job managing the process so far because they came out of an economic cycle caused by COVID that none of us ever expected. And I think for what we do on the direct lending side, most of the businesses that are bought by private equity today are relatively non-cyclical businesses. So if you look at the Preqin data, 70% non-cyclical in direct lending. If you look at the high yield market in Europe, it's only 30% non-cyclical. And so, the high yield market's kind of financing what I call old industry, and the direct lending market is primarily focused on the new industries, so software services, outsourced business services, healthcare. And the consolidation game that you've got to go through in Europe, which is miles behind the United States in taking these mid-sized companies and building much larger companies, is still incredibly early days. So yes, we have to make an adjustment. Yes, we have to think about leverage. Yes, we have to think about free cash flow. But they're all things we were super focused on before. And we're in industries which don't have high capex and don't burn a lot of capital on R&D or other types of costs. So, it's hard to say credit's in good shape, but I'd prefer to have credit today than have real estate if I'm sitting there today as an asset allocator where cap rates are changing and utilization is drying up.
James.
Yeah, I'd say for us, it's relatively hard to move our portfolio quickly. We have north of 100 billion Canadian dollars in the credit and rates portfolio, so you don't pivot that overnight. What I would say is, at the margin, what's interesting for us is we have to deliver a set nominal return to meet the needs of the underlying pension funds for whom we manage capital. And actually, in this environment, you can get that return by taking much less risk. So you can move up to higher quality credits, perhaps shift your asset mix away from perhaps equities, private equity, towards private credit, and actually end up satisfying those obligations in a much lower risk manner.
And Nicole, when we were having this conversation, you have said that supply has gone down, and so it's not so good a time for lenders. There's not currently a lot of choice out there.
No, there's not. But to Symon's point, I think in these uncertain times, what you do see is that it's only the best credits that come to market, so less selectivity but better credit, so you can afford to be less selective. And as I mentioned, a lot of the deal flow is coming from buy and builds and existing portfolio companies that we know, that we like, that we've seen the kind of business case being tested through difficult periods. So it's a matter of adding to that as opposed to, a brand new company that we don't have the experience with. So I think for experienced lenders who have been through multiple cycles, quite often it is just seeing the same companies, and the good news is you have the data on how they've performed already, and to Simon's point, where they've already made tweaks and tightened up what they do. So I think you're right, less selectivity, but better companies anyway. So whereas in the kind of markets pre-COVID, you were seeing kind of, travel, hospitality, all the kind of industries that we have stayed away from, and they're just not an option anymore. No one's financing them.
I would just add, Fiona, you're still in a early stage of transition of assets out of the banking system to private managers. And so, post the Resolution Trust and everything that went on in the United States in the early 90s, the evolution of credit card companies, mortgage companies, ultimately direct lending businesses, etc., saw the banking system hand over a whole series of asset classes which got securitized and sold into funds and all type of that. Europe, really up until 2008, was dominated by banks and very small number of specialized financing firms. You're now a decade on. Yes, some of that's moved, but every time you have issues in the banking system, another big chunk of that moves out of the banking system. And one thing we've got to realize in Europe, we have too many banks. The United States has 4, Canada has 4, Australia has 4, Europe has about 40 national champions. And the ECB will only ever fix the banking system in Europe when it gets that number down to 10 or 15. And national vested interest prevents that. So the French don't want to give up control of the banking system, nor do the Germans, etc. So you have a dysfunctional banking system that's going to be there for a decade plus, which means all the assets are going to keep moving into James's hands and our hands because they can't hold it. So you've got a mega trend happening inside of Europe, which is decades behind the United States, and the quality of assets coming out are good assets.
So what I'm sensing from this panel is you're all very cognizant of what's going on out there, but you're finding opportunities in these markets, and it's not all doom and gloom, which is I feel a little better than I did this morning. Okay, moving on, James. I don't know whether this is the best question for you, but how are you hearing and seeing borrowers responding to this level of uncertainty?
Well, it's interesting, and I think actually, Symon, you put it very well. A lot of borrowers that we deal with really did get match fit during COVID. So what I've been surprised by is, yes, there was a bit of a hiatus after the Ukraine war began. People didn't know how long it would go on, exactly what it meant. But I've been struck by how quickly the management teams we interact with have seen and recognized that the world has changed. They're taking action. They're reducing costs. They're perhaps saying, look, these growth programs or projects at the margin, am I going to do them? They're focusing on strengthening balance sheets. They're managing working capital. They're increasing cash in their businesses. So I've actually been very pleasantly surprised, and it's things like that, I think, that create opportunities for people like us. Because when the banking system is under stress, I think people look for alternatives, and maybe they wouldn't have considered any of the lenders on this pay or on this stage a couple of years back. But I think now they're saying, well, actually, I need somebody who can monetize a contract, who can finance an asset for me. Banking sector under pressure doesn't want to do it. Who can I talk to?
Matthias, how are you finding your borrowers responding to this?
It's much of the same. People are concentrating on the basics. We're active in a space where a lot of the companies are still in their earlier stages. They are VC funded, and that's been an environment that over the past few years has not been very conducive to cost consciousness, to really keeping a close lid on everything, and they're learning that now. In the past, they could just go out and raise another capital round at yet a higher valuation. That's not happening anymore. So they really have to get back to the basics and have to find a path to profitability and very quickly. And that's, in my view, that's a very, that's a very healthy development, because in the long run, businesses have to be profitable. I mean, companies like Amazon have shown us that you can go on for a long way, just growing without looking at profitability, but eventually you have to get there. But not every startup is an Amazon. So now they have to start looking for a path to profitability much quicker, and that's a good development, and that's what we're seeing in the companies that we're working with.
I mean, just to add to that. All the companies that we lend to are owned by private equity sponsors. And I would say some of the lessons learned even further back, going back to the great financial crisis, you've definitely seen being put to play through COVID and post-COVID. So kind of moving early, and that is quite often kind of adjusting management teams to ensure that they do make that switch from a growth environment to one which is more kind of cost conscious. But I think also the fact that when you look at the companies that we support, we've got much higher levels of equity contributions behind us. So that's quite a lot of capital that private equity sponsors have to protect and make work for them. So we're seeing a lot more of the kind of, proactivity and a lot more support as well, sometimes monetarily, sometimes by changing of management or management styles. But all of that, and those were lessons I think that some of us lived through in the GFC, which were less pleasant. And we're seeing that running much, much better ever since kind of COVID and beyond, I would say.
I think maybe just to add to what you said and referencing back to the GFC, the thing I've also been struck by, having been on the other side of the table during the GFC, is the transparency and engagement that we see from our borrowers. Even when things are not going well, they're actually talking to us early and being pretty open and collaborative, which makes a big difference.
Symon, have you got anything to add to that?
No, I think we've covered most of the points. I think where most institutional investors are today is they're doing a rethink of their whole asset allocation. Infrastructure has been a huge beneficiary in a low interest rate environment, but now that government bonds yield as much as they do, infrastructure debt doesn't look that appealing. Infrastructure equity, still, I think, a lot of money. I think if you come into private equity, people have been super selective on which managers to go for in the next round of funding. I think if you come into real estate, Blackstone announced their $30 billion real estate fund, which is great for them. But I think most institutional investors I talk to globally are very nervous about their real estate portfolio and what the implications are going to be. And I think credit is going to be one of the big beneficiaries, because very much, as Nicole said, in environments like now, only the best credits come to market. So private equity firms look at the best companies, they're lower leverage, there's more equity, these are great deals. The challenge for all of us is looking at what we did 2 years ago. But if you look at what the market was doing 2 years ago, it was miles different to what we were in 2006-07. We were sitting there with 50 up to 60% equity checks in businesses which were growth businesses in a new economy rather than, I would say, dinosaur businesses in the old economy, which is what we were doing, in the early 2000s. Retail, auto parts manufacturers, and areas which have died out substantially. So I think most big institutional investors, I agree with Nicole's things, they were very cautious because of the volatility in fixed income. But in the last, certainly quarter, if not two, they've all of a sudden started to come back and say, listen, we want to put more money into credit because we don't see the other asset classes as being as attractive in the current environment.
Okay, thank you. I just want to pause the panel. I've got a couple of more questions for you, but have we got any questions from the audience at this point? That's a no, okay. We'll power on then. what are you doing with your current portfolios? What are your actual, Nicole, I'm addressing this to you because you had quite a lot to say about this on the call. What are your current priorities in managing your portfolio? What are you thinking, we have to be on top of this, we should be doing this, and we certainly weren't prioritising that sort of 4 or 5 months ago?
I think it's kind of more of the same, but at the end of the day, what we do with indirect lending is fundamental analysis of each of our portfolio companies. So at MV Credit, for instance, I think across all of our funds right now, we lend to about 67 companies. So we know them quite well. It's not a statistical analysis, it's a very kind of bottom-up approach. We are engaged with all the management companies, with the private equity sponsors. Monitoring is absolutely key. It always has been, but it gets even more important in these kind of environments. And it's not just about looking backwards and seeing how your companies are behaving versus what we thought they were going to do, but also looking at what's going to happen in the future. So at MV Credit, we have this term, which is that we all have healthy paranoia. So what's the next thing that is going to cause a problem for us? We don't really care about the upside. It's all about minimizing the downside. So where is the next downside coming from? So to give you a sense, when we were underwriting credit about 3 years ago, we were assuming inflation. We knew nothing about what was going to happen in Russia or Ukraine, but it had to come. There'd been 10 years of no inflation. So we were building in interest rates of 2 to 3%. We're building in higher interest rates now, but it is tweaking what we were doing, staying kind of rigid with the principles and the way in which we underwrite, but then really, really monitoring what we do. And that is, on a weekly, daily basis. Again, across our 67 names, we'll probably have 3 or 4 that we would call kind of focusless names, and there's a lot of attention being spent and engagement on that. So, the general environment is important, but the specifics to each of the company are as well. And that kind of level of due diligence and monitoring is key through this period.
Matthias.
Yeah, really, I think the point for the existing portfolio of monitoring is a very important one, and it's one that also in our context has always been very, very much a focus. As I said in the beginning, we're financing asset portfolios. These are granular portfolios with many underlying positions, and those actually tend to lend themselves to statistical analysis. So keeping a close tab on them, receiving daily or at most weekly loan tape data from the originators on those portfolios, doing statistical analysis and spotting trends early is something that's absolutely key, and it's something that we had a great dry run on in the beginning of COVID, because everybody was kind of like a deer in the headlights. What's going to happen next? And to have real-time information about how your lending, how your credit portfolio is doing, was very valuable, and it allowed us to put on the brakes, to stop origination, or to reduce it to a point where we could still observe trends without having much risk on it. And then as things became clearer, to then open the taps again and ramp up the portfolio again. That was very helpful. That's the technical side of monitoring. The other side, which is more the human interaction side, that James was talking about earlier, constant engagement with management, and if they are seeing things that that you should know, that you have an open communication channel to hear these things straight away and not after the fact. So that's very important in terms of the ongoing portfolio monitoring, in terms of future origination and of new deals that you're doing. I think in the current environment we're in a much better place. As Nicole was saying, there are only higher quality borrowers coming to the market, and also you're facing less competition. So you can achieve better terms, and those could be purely economic terms in terms of the interest rate that you're charging, but there could also be other things like more technical factors, covenants, advance rate, general structural things that help you as a borrower to be in a safer position.
Thanks, Matthias. I'd like Symon and James to add anything, but could we have a microphone for this gentleman over here, please? And if I'll ask you to ask your question after Symon and James have opined. James.
I think it's really what's been said has been comprehensive. I think the only other thing I'd add is, you're starting now to see borrowers approach you. Maybe they're finding some elements of the facility don't work in this market. So one of the things we're doing is, in any amendment request or anything like that, being very conscious of what's our credit position. We've become incredibly fixated on cash, access to that, collateralization of our facilities, any cash leakage out of our SPVs. So that's become a big focus for us in monitoring or in managing that.
Have you got anything to add, Symon?
I haven't got anything.
Okay, thank you. The gentleman in the white shirt.
So, just to ask Nicole, you were saying the importance of monitoring every single day your portfolio, and I guess everyone agrees with that. It sounds obvious, but if you do see things going wrong, there's no secondary market in these assets, is there? Is it really just a valuation question, or what does one do?
It's a really good question. So I would say for the larger side of the market, so most of the deals and the loans that we make, we are one of a small club of lenders typically. From time to time we will do the smaller syndicated deals which have a little bit more liquidity, but by and large you have to assume no. There's not a lot of liquidity, to your point. What it deals with is if we've got it horribly wrong, there is always a price you can sell, but that is unlikely to be the option. So it's much more about engagement with the private equity sponsors and the management teams to ensure that there is a plan A, B, C, D, and what does that entail. And to a large extent, that will entail support from us as well. For instance, we lend on the senior as well as the subordinated side of the capital structure. As a subordinated lender, quite often we will, for instance, look to reduce or pick some of our interest for a period of time to provide more liquidity. To be honest, we've talked about the leverage and covenants, and those things are important, but those are literally just measures. They're not actually going to make a company do something or go into a difficult period. What is really key is liquidity. So it's all about shoring up the liquidity of the company and ensuring that these companies, which by and large will survive if they're given support through a difficult time, have the liquidity to do that. And that will come from a range of sources. In the first instance, you'd expect the support of the private equity sponsor that owns it, but certainly the concept is to be collaborative, engaged, and find solutions for the company as opposed to finding a process or in any way being kind of combative.
Thank you. We have one more question.
Thank you. So we heard from the previous panel, they were discussing about investing in clean energy markets. And maybe this is a two-part question, but are your investors asking for you to invest in, like, using ESG metrics? I guess that's the first question. And secondly, as private credit investors, do you act as activists, or is that irrelevant? Thank you.
Who would like to take that?
I'm happy to, because I talk to investors, and this question comes up, and this topic comes up in every single conversation with every investor. So the answer is yes, they absolutely expect us to be ESG conscious. The truth is, if you're on credit, you should be, for credit reasons as well, because when you're looking at what can affect the cash flow of a company, it can be things which are ESG related. I think what's happened in the industry is the formalization of the information we receive and how we treat that. So, and of course, as lenders, we have developed ways to engage with that. For instance, sustainability-linked loans, but increasingly in documentation, the requirement for information and also the measurement of ESG. And by the way, diversity and inclusion as well. I'm kind of putting that in, not just for our portfolio companies, but us as a manager. So all of that is extremely topical. As per the previous panel, for instance, we're looking at, decarbonization funds. We're looking at specifics that are very ESG-led, but even in our normal funds, which are SFDR8, a European kind of measurement, which holds you to a higher standard. Most recently, we have actually started to link our compensation to ESG as well as financial performance. So it is front and center of everything we do. In terms of activism, huge. We're one of 2 or 3 lenders with one, owner. So in fact, the ability to change things, to improve things, much higher in the private markets than it is in the public markets.
Thanks, Nicole. Would any of our other panelists like to add to that at all? If you'd like to.
Maybe
James?
if I could just give the CDPQ perspective, because, on the one hand, we're a direct lender ourselves, but we're also an LP. And for us, because of our responsibility to the people of Quebec, ESG is actually incredibly high on our agenda. And I think the way we think about it is that it's not just binary. Something is ESG compliant and you invest, or it isn't and you don't. So we actually created a 10 billion, what we call transition envelope, which is to identify companies or projects where perhaps they're not, say from an environmental perspective, good today, but they have an opportunity and a clear plan to decarbonize or improve themselves. So for example, we funded a power plant business that was transitioning from coal to renewables. So things like that, you can actually provide capital to help drive change, which I think is really interesting.
Anything else? We are out of time. I think what we can get from this panel, there are challenges, but there are lots of opportunities in this space. There's a lot of rhetoric around there about, private credit, shadow banking. I think this panel has demonstrated there's an awful lot of transparency and due diligence that goes into the work that private credit managers do. So I hope you can take heart from some of that. We have overrun, I'm very sorry, but thank you very much for your time.